Good morning, everyone, and welcome to the May 19th, 2026 Pension Committee. I would like to start by calling roll. Mr. Phillips Cigar.
Present.
Eric Watkins. Nikki Falconberry.
Present.
And new member, Lady.
Present.
Good morning. All right, we do have quorum. I would like everyone to look over the minutes. Minutes is for November 11th meeting and February 10th, 2026.
Can I point out one thing? I know I'm not, for the others present, Morgan was here with me at the last meeting as well, and not Ms. Thompson.
Thank you.
I make a motion to approve the minutes.
All second.
Second motion.
Thank you. All right, we can turn it over to Meredith to give the performance report.
Thank you so much. We're always honored to be here. It has certainly been a interesting first couple of quarters of the year, so we're happy to give the color on the performance of the portfolio, as well as what has happened and what we see moving forward. So thank you so much for having us here. Just to start, we'd like to give any updates that are happening with the firm. There's nothing major other than our continued growth. We continue to push forward. We're currently managing somewhere in the $650 billion of client assets currently, which we're very proud of. But along with that is that nothing that we do is rote or automatic. Everything is customized. So as we continue to manage the Lextran account moving forward, understand that it is always informed by your specific investment policy statement. And I'll use this as an opportunity, as I've said a handful of times over the last couple of years. If at any point there is a desire to review or just take a look at any of the areas of the IPS, we're happy to both lend an ear, a voice, and accommodate any changes that may happen going forward. We do on page 5 continue to participate in one ranking and one ranking only, and that's Barron's, because we can't do anything to influence it, so we appreciate that. And every year that Barron's has ranked registered investment advisors, meaning fiduciary advisors nationally, that Mariner is ranked in the top 10. We're number 6 for 2025. Every September we wait and see where we rank, because again we have no input on that. So this is solely due to the reports of our client experience, and so again we take great pride in the fact that we continue to receive recognition from Barron's through this ranking. The next page, on page 6, reflects the local team that has a direct hand in the Lextran account. You can see Pam is still heavily involved. Myself, Morgan, our newly promoted managing director, Michael Gosney, and our support staff work as one Mariner to ensure that we are delivering on the promise that we have made to be proper stewards of the Lextran account. The last page in this section that I'll touch on, because I think it's always important to keep in mind as we're moving forward, the summary of the investment policy statement, and that's the allocation ranges. The current available range on cash is 0 to 10%, with a target of 5. bonds is 20 to 50% with a target of 35, and stocks is 50 to 80% with a target of 60. Necessarily as the performance is warranted, we've seen, and we'll cover this, but we've seen a gravitation in stocks, both as we have leaned into where the performance and the risk-adjusted performance has been in stocks, as well as the fact that there's simply been more growth there, and so that tends to self-distort the percentages, but we are still within the pension, the Transit Authority pension plan investment policy statement. Skipping forward then to to the end of the first tab, and just looking backward, or where we are, year to date in 2026, it continues to be a strong year for the equity markets, albeit an uneven year. If I were to tell you that the S&P was up as of the end of April, nearly 6%, I don't think it feels that way, but it is true. That the Dow is up nearly 4%, same. International markets, as represented by the EFI and the emerging markets, have had even better years, with emerging markets up through the end of April nearly 15%, and the developed markets up over 6% for the year. And stuck in between those is the Russell 2000, which is small cap. So, the last year continuing into this year, we have finally seen a recovery in small cap equity performance here domestically. All blended in has led to a continued positive experience. Now, it's one thing to see these numbers at the end of April. If we were looking at these same numbers at the end of March, they wouldn't have looked as rosy. So we certainly saw a somewhat of a recovery through particularly the back half of the month of April, continuing into the early parts of May, although we're certainly in a more volatile environment now. The market has, on page 19, reconcentrated. We started to see towards the end of last year some of that concentration slipping, where the top 10 the top 10 companies of the S&P 500 had gotten down to somewhere closer to 36% and dropping. The top 10 companies in the S&P 500 now are back up to 40%, not quite to their peak, but still a large percentage of the performance is being driven by the larger companies. That said, it doesn't necessarily mean that it's unhealthy. It can feel a little nerve-wracking to have so much performance tied up in so few companies, but when it's being driven by actual earnings, then we're a little less worried about that. So as you can see, the performance, and particularly the growth of earnings, has traced the performance of the underlying stocks. So those two things aren't divergent. That would be more worrisome. If you saw earnings flat and those stocks rising, that would be considerably more concerning for the health of the market. But as earnings have grown, stock prices have grown, and candidly, that's the way it's supposed to work. So we're not so down about that. On page 20 is the interest rate curve. This, as we sit here today, literally is the topic du jour, as interest rates have increased. There's a number of reasons. A large part of the reason is the ever-growing debt load of the U.S. government makes 10 and out bond yields a little tend to gravitate up. When bond yields, which the 10-year, as I was getting out of the car, was over 4.6%, that means your mortgage is higher, because even though they're 30-year mortgages, they're based on the 10-year because most people don't stay in their homes for 30 years. It's a little trivia for today. That rate also competes with stocks. When I can get nearly 5% guaranteed-ish out of a bond over the course of 10 years, I'm much less likely to take a risk in stocks. So you start to see that competition, and that's why we started to see here in the last few trading days some additional volatility. So those things go hand in hand. It's not quite as streamlined as that, but just to keep it on the straight and narrow. So I'll turn it over to Morgan now. She'll take you through the portfolio, and then we'll come back for some more economic view.
Yeah, so taking a look at the portfolio, I know we talked about the end of the year 2025 last time we met, so I'll just kind of focus on where we are year to date for 2026. So we see the total portfolio year-to-date is up 3.6%, with that being made up of fixed income up 0.7% and the equities and alternatives up 5.3%. In our little pie chart over here to the left, we see how that is broken down within the asset classes, with just under 50% of the assets being in the large cap stock category. As Eric mentioned, we do have where the equities and the alternatives make up about 74% of the account, and the cash and fixed income make up that 26% remaining. The portfolio is averaging just under 2% in annual dividends and interest at over $525,000, so that is a nice little addition there. And then at the bottom, it just kind of shows the equity value being at, let's say $20.5 million, the bond value right over $6 million, and cash around $1.3 million, for a total value of the portfolio of $27.8 million. And then on the next page, we'll see a little bit of the summary of the account so far year to date. We started the year at $26.8 million, and then we've had some cash flow come in. We've had dividends and interest of over $140,000 pay into the portfolio, some bond accrual in there, and market increase of over $817,000 so far through the year, putting us at $27.8 million. So up about $1 million so far. Page 23 is going to break down the individual equities, similar as we've done in the past. You'll see on the left side, we kind of group this into 3 categories, but on the left side, we have your higher income, less risk stocks. So think of, some financials in there, looking at PNC, Eli Lilly, and pharmaceuticals. So those are going to be the ones that have a higher dividend yield or are growing their dividend at a nice pace. That middle group is going to have our cyclical growth stocks, which are going to be the most actively managed, meaning these can change very quickly within the portfolio. So this is going to, our team will trade in and out of securities depending on where we are in the market cycle and the economic cycle. And then on the right side, we have our high growth, more higher risk equities that kind of drive the growth piece of the portfolio. So you'll see a lot of very familiar names in there, Meta, NVIDIA, Oracle, all kinds of things there. So those are either growing their earnings very quickly. With that can come high PE ratios, but again, earnings are proving that these higher PE ratios are justified. So we are very comfortable with what we do own in the equity portfolio. On page 24, you'll see the top 10 individual equity holdings within the portfolio. So you'll see number 1 there is NVIDIA. That has a total market value of just over $1 million within the account. You'll see if you go through that list, probably every single name is recognizable to you all. But the main point I would like to make here is that we don't have too much in any one equity. That's the important piece, that we have a very diversified pie chart here. So that's the important piece. And then similarly on the next page, we have another diversified pie chart there, just breaking it down into sectors instead of individual securities. So you'll see the largest sector that we hold is in technology, just under 40%. It's a tad higher than what the S&P has, but we do believe that's justified. So point is there is, it's very diversified again, but we do believe that we have the right allocation among sectors. And you'll see quite a few sectors there. On page 26, looking at the equity fund holdings. So this is kind of where we make up the rest of the equities within, our large cap growth. We have large cap value, small and mid in there, along with international. So we'll see year to date, looking at the Russell growth, it is up just under 1%. The Russell value is up over 10.4%. And if you compare it with the S&P 500 index there right below, at 5.7%, that value has outperformed growth so far this year. If we look down at the small and mid cap in the Russell 2000, that one is up 13.1% this year, in line with the index. And then for international, we see that it is up 6.6%, right in line, just a little bit ahead of the international index as well.
I'm going to just make a point on the value versus growth. That can seem a little like we got the numbers wrong. If you look at where the semiconductor stocks that have driven so much of the return, again, until here the last couple of days, the number one performing stock in the Russell 1000 value is Micron, one of the semiconductor stocks. As difficult as it is to believe, with a nearly fourfold increase this year, their earnings have actually outpaced that. And so their P is actually lower today than it was at the beginning of the year based on forward earnings. So tech stocks have outperformed, but the tech stocks that are in value have actually been the ones that have run so heavy. So you've seen this displacement. So that is oddly not an error. I'm sorry.
No, that's a good point. Very good point. And then on page 27, it takes a look at the bond review. So you'll see another pretty pie chart there. And what I will point out is that we do have over $1 million coming due within the next year, within the next 365 days. If you look through, you'll see the highest chunk is in that 1 to 3 year time frame at around $2.4 million. And then we also do have some built out 3 to 5 years, 5 to 7, and then some longer term bonds as well. And as those do come due, we will reinvest those out. We'll ladder those out to kind of keep taking advantage of the yields as they are attractive. And you'll see kind of at the bottom just where it shows the value of the bonds being at over $6 million. Any questions about anything in the portfolio for you all? I know I kind of went through that kind of quickly.
All right, well, if anything comes up, we're here, but I will move on then to the broader economic and market overview on page 29. U.S. gross domestic product, first quarter of 26 came in at 2%. We've started to see a bit of a slowing, or re-slowing, I would say, in overall GDP. But with that, the basis of economic growth remains intact. The consumer is still consuming, that businesses are increasing their capital expenditures, so we see that actually expanding. Government spending is still government spending. It's not going away. So some of the areas where we have seen a drag is on net exports and in residential spending, meaning new home building has shrunk in the first quarter, so those took away from overall GDP. I'm not sure that I can tell you that that's going to look materially better in the second quarter. In fact, my assumption is that it won't. But again, the main drivers of U.S. gross domestic product remain healthy and intact and should continue to push us out of recession. Perversely, if it ever comes across as though we are being we as the House view, and me personally, rose-colored glasses, one of the things that we have to recognize is that things like gas prices, when they go up, until they hit a certain level, which is very cyclically dependent, that higher gas prices can actually make U.S. GDP look better. It doesn't make our lives at home any better, but it can make statistics look better. Because if I still need to get to work and I'm still driving my own car, then I have to pay that gas price. That is a retail store sale at that location. That higher price, let's say it's 20% higher, means 20% higher sales. That factors into GDP. So all of these numbers have to be taken with a broader understanding of what's happening. But what we do know is that retail sales continue to be strong. That overall general consumption continues to be strong. How long that lasts when underlying costs continue to eat away at household disposable income remains to be seen, but that's the current state of affairs as they lay. And one of the things that a chart that I put in, a couple of new ones for this one, is the next page. I keep making the point that a high PE on the market, or an expensive market, can be solved in one of two ways, and there's really not a third. Either the price can be reduced, meaning that the market comes down overall in price, thereby reducing the P, or you can increase the denominator, increase the E. And what we have seen, at least to this point, is that the denominator continues to increase. We have seen record growth in corporate earnings. Yes, there is some concentration there, but not as much concentration as you might think. That there is, that the earnings reports have been historically high and have been historically outpacing expectations, which actually is a bigger indicator of how stock prices move, as opposed to just being really good and everybody knew it was going to be good. But earnings surprises have come in at a record 87%, which is a staggering number, and that continues to push. So we are not so much worried about the valuation of the market as it stands. That changes all of a sudden if, again, external events start hitting the E, then all of a sudden that separation becomes more problematic. The next slide is on inflation. I think if I was going to go back and redo this slide, I would probably change the title of inflation concerns are subsiding, as at the very least inflation fundamentals are subsiding. An increase in prices isn't necessarily inflation. It just becomes a buzzword. We lump everything in as inflation if it's increasing prices. And so the monetary function of what would cause inflation is subsiding, but that doesn't mean that prices are subsiding. And so if we look at where CPI is baked in, it is no surprise that as of the end of March, the area that has peaked up, you can see the green at the very top just screaming out and letting you know why the CPI number has increased as energy prices have increased. So the good news is that energy prices as a percentage of household spending are lower than they were when I was sitting in my grandfather's green Malibu on odd number days getting gas in California, but it doesn't mean that it doesn't have any impact. And so that is eventually going to have some ripple effects through the overall economy as people have to adjust to it. On page 32 is the labor market. We are in, perversely, a bit of a Goldilocks scenario in terms of the labor market, although I would say we're on just the underside of that scenario, meaning that wage growth continues to be good, but we are gotten to the point where it's average, and unemployment is well below its long-term average, so those are both reasonably good numbers. The dark side of that is this has been the first quarter where wage growth came in underneath inflation growth. So we actually saw a reduction in overall real wages for the first time in a couple of years. So certainly the energy shock has played a significant role in that, and hopefully that will again diminish quickly. On page 33 is another of the newer slides that I put in just to make the point that consumers keep consuming, that retail sales continue to grow. Even when you take out some of the larger ticket items, they continue to grow, and that is for a consumption-based economy as opposed to a mercantilist economy such as the one that we live in. That is a positive sign for overall ongoing economic prosperity. On page 34, it shows the track of the Federal Reserve, the Fed increasing or decreasing rates. I think it is fairly well established now that there won't be a rate cut anytime soon. So I would again retitle this slide maybe to the Fed had been lowering rates and now is in a wait and see. There is some discussion of raising rates moving forward. I don't think that is likely to happen. And if it does, I think that's misguided in that I don't know that you're promoting economic activity. You're not going to bring gas prices down by increasing rates. You're only going to cause more harm to the consumer by increasing rates, providing additional friction in the economy for the consumer while they're also paying for higher gas prices. I think rationally, that's how what the Fed will see, and that's the difference between what is inflation and what is price increases, but we'll see. But one thing is fairly certain at this point is that we are not anticipating any rate cuts anytime soon, no matter who would like to see those. On page 35 is the last of the new charts that I've added, and that is credit spreads. Credit spreads show you what the difference is between high yield, or some might refer to it as junk bond yields, and where investment grade yields are. We see those, if you see wide spreads, then that's historically a dangerous time for the bond market. When you see tight spreads, that tends to mean there's some comfortability with borrowers' ability to make their payments wherever they are in the FICO score structure, for example, and we're at a fairly tight spread environment right now, which means that individuals' balance sheets currently look good. Again, the continued strain of increased prices will ultimately have an impact on that, but as we stand here today, it's a watch signal, not a clarion call to make significant changes. On page 36, consumer confidence is at a low, not a historic low, but certainly is trending down. Historically, when we see consumer confidence or investor sentiment at a low, that's a great time to invest in stocks. The next 12 months after that tends to be exceptionally bullish. This is a contrarian indicator for us because that means that a lot of money that could be spent or invested isn't being at that given time because people are nervous and so they're keeping powder dry. Again, historically, if you look at any of those blue dots on the bottom, the following returns of the market after that tend to be very, very strong, and for understandable reasons, consumer and investor sentiment is at a low point and trending lower. So as we wrap up for some of our familiar closing charts, the fundamentals, valuations, and technicals, which is the paradigm in which we review all stocks and the overall market. Fundamentals meaning your earnings, just the basic blocking and tackling of your economy or your company. Valuations, how cheap or expensive are you relative to your group and history. And then technicals, momentum is a real thing. Overwhelming demand for stocks is never a bad thing for those stocks. So we look at those types of things. And overall, if we take the measure of where the market sits, we look at it as a neutral to neutral positive. There are some warning signs, as I've discussed here, that we are keeping our eye on that might change that view. But overall, we are in a cautiously optimistic position for both the economy as well as both the stock and the bond market as we sit here today. But that is as a reminder, as always, that even in a positive year, as most years, the overwhelming majority of years are positive years, that there are corrections in every year, and guess what? We've already had one. We got down intraday below 10%, so we've seen a 10% decline already this year. We may see another one. There's many months left to go, but you know, the month of March was not the happiest month in the equity market, so we have seen that. But we've also again seen a rally back positive already year to date, as we have again. There were average declines of over 14% in 35 out of 46 years, and yet the vast majority of years we wind up with positive returns, and mostly significantly positive returns. So we managed through that for the long term. Just a reminder of our base case for the year, which we have not changed. We look for an S&P level of 7,700, which would represent a 13% total return for the year. We're at 5 and change, coming up on 6 now, so we're about halfway there so far, and it's May, so I'd say that's we're on pace for that call. It is our job to look through near-term volatility into long-term for the plan, and we will continue to do that. So with that, and as we have been requested and have been doing recently, all of the individual holdings, equity and fixed income, are in the final appendices. So if you need some light reading to help you sleep tonight, it's right there for you. With that, Morgan and I are happy to answer any questions, but thank you again, as we do always, for the opportunity to serve.
Question? Thank you.
Absolutely.
All right, so before we turn it over to Mrs. Steve and give the next report, I do want to take the time to mention that Mr. Fred is also present. Hello. All right, moving on to the next report given by Mrs. Steve, Osborne, Carrier, and Associates. You can take the floor, sir.
All right, thank you. I believe you have this report right here. And maybe I think we sent it to you electronically. Okay. What I'd like to do is simply go through the base pages in the front, which summarize the condition of the fund. What I've done basically is look up the assets of the fund at the beginning of this year, January 1st, 2026, and estimated, calculated what the expected payouts are for the future from the people that are on hand right now. And let's measure the long-term liabilities of the fund and then compare those. The number of, if you look on the first page, there's 3 columns, and the numbers on the right are the most recent results. And you can see that the number of individuals has jumped a lot since last year. This is mainly due to the increase in the number of active people working in the plan. It's up to 205. There's 111 people that have quit that can get a benefit when they reach retirement age, and then at the time there were 78 people here on a monthly check, and we're paying out about $56,000 a month in pensioners. Assets were just under 27 million, and we had calculated a return net of expenses of a little over 12%, which was good for the year. We saw ranging anywhere from 9 to about 12.5% for the year. So y'all getting 12.2 was pretty much toward the top. Still on the front page, the recommended contribution rate has gone up since last year, again, mainly because there's more people to $202.61 an hour. We're actually putting in $2.44 an hour. So that's a little bit more than you're putting in. Offsetting that, though, is that the plan does have more assets than liabilities. You can see that in particular, assets exceed liabilities by $7.3 million, which is up from a $5.2 million margin last year. And that increase in the margin is mainly because of the good investment return. And the projections assume we make 6% a year, and so when you make 12.2, that increases assets more than expected and lowers your unfunded liability or decreases that surplus there. At the bottom of page 2 and the top of page 3 is information about what it would cost to raise the benefits, because you've asked me to do that every year. Right now you have a benefit of $60 per year service, and if you increase that by $10, that would raise the cost of the plan by $1.05 per hour. And I'm saying $10, that's not a recommendation or anything, I'm just using that because it's proportional. So if $10 costs $1.05, then a $5 increase costs half that, or something around 52 cents. Or in other words, it's costing them about a dime for every dollar that you would increase that benefit over 60. I can't recommend an increase at this time, mainly because the recommended contribution is 261 and you're putting in 244. So that's where we are. I want to point out at the bottom of page 3 some risks of the retirement plan. There are a whole lot of risks in a retirement plan endeavor. Yours are primarily your investment returns and a decrease in hours. We're assuming that contributions are made on about 350,000 hours a year and that you make a 6% return. If you actually have a 0% return next year, that would increase the recommended contribution rate eventually by about 70 cents an hour. And if hours fell to 300,000 a year, the recommended contribution rate would increase by about 43 cents an hour. Now, behind the assumed hours assumption, obviously that depends on how many employees you have, which depends on ridership, which also depends some on financial strength of the county. So any of those things can affect your hours. Let me just stop there and see if there are any questions.
You mentioned a figure for the per month spending. What was it again?
It's 56, a little over 56,000 a month. Let me look that number up. At January 1st, it was $56,485 a month.
My question, I asked you for how much we were spending per month, and it was $60,000.
That would, it would fluctuate depending on who's retired.
Gotcha. So,
And that number is your monthly pensions. It doesn't include, there are people who get refunds of their own money, and that varies from year to year. Last year it was around 148,000, and 2 years ago they drew out 384,000. So that's in addition to the 56. The 56 is month to month people drawing a monthly pension. On top of that, you would have refunds that some people get, and you have some administrative expense.
thank you.
The rest of the report, there's a table of contents right after the beige pages. I tried to summarize everything in the summary of the report. And the exhibit kind of gives the detail. On page 3, exhibit 3 is a summary of the financial statements. And there it shows the expenses at the bottom of page 3 broken out by what kind of expense it is. Administrative pensions under 2A is the monthly pensions that you're paying every month. And then B, refunds are just, it depends on who leaves that year and whether or not they want a refund. Assets are all listed out on page 4 or listed out by category. Can I answer any other questions for you?
According to your figures, we are projected to be underfunded eventually, just based on that we need to raise our rate, I should say, contribution rate. That is correct?
So if you maintain the status quo, you putting in 244, and the plan really costs 261, then what would happen is the overfunding would gradually come down over time. I would not say it's necessary to raise contributions at this time. We certainly can, but it's probably not necessary. And part of the reason I say that is that the cost has been fairly stable from year to year until this year when it increased to 261. So I think before I reacted to the recommendation being higher than what you're putting in, I think the current employment level take out a little bit. Does that make sense?
So what you're saying is not this year, but can I get a range of when you would suggest we start raising it?
I would probably wait at least a year, maybe two. I'd see what happens, what it looks like a year from now, and it's still at 261, then I might wait the third year and then start worrying about it. And in the meantime, you'd also see how much that brought down the unfunded liability, or brought down the surplus. And the surplus is there mainly if we have an investment loss. And I know Eric has been doing great. A good market 3 years in a row kind of makes me a bit nervous about what's next. But I guess we'll see. Yeah, so Eric, I wouldn't raise it this year, and I probably wouldn't worry about it too much next year either, but probably year after that. And thank you for having me. If a question comes up later, just let me know.
All right, moving on to the next agenda item, any old business? Seeing there are none, any new business? All right, the next pension committee meeting is scheduled for August 13th?
11.
11th, August 11th, 2026. And with that being said, meeting is adjourned.